Hi friends, Simit here from informedtrades.com. Next up in our trader profile series, where we take a look at successful traders and what they've accomplished, what we can learn from them, is Ray Dalio. Ray Dalio was featured incidentally in Hedge Fund Market Wizards, which talks to many hedge fund wizards about or hedge fund traders about their strategy. It's a great book by Jack Schwager. I do recommend that. And this video draws from the interview with Dalio in that book. Ray Dalio is the founder of Bridgewater, the most successful hedge fund ever. If you look at how much money it has returned to its shareholders, more than any other hedge fund. It's also huge, over 50 billion with assets under management. So it's pretty impressive that they're able to generate sizable returns at that, managing so much money. They have a fundamentally systematic approach. We'll talk a little bit more about exactly what that means. Dalio was a student of history, and his trading approach really draws upon history. Long-term cycles and examining what's happened throughout time. Taking a very, very long-term approach, big picture approach, is key to his edge in the markets. Diversification is the holy grail of investing, something that Dalio believes in. And anyone who has made money in trading has had to experience horrendous pain at some point. A quote from him on trading psychology. A fundamentally systematic approach. Sort of what that means is Dalio's approach and the approach utilized at Bridgewater is very rules-based, but at the same time, it's rooted in fundamentals. So they don't use technical analysis at all. They do everything's fundamental. But since it's systematic, it's still numerical. It's still numbers based. So they will look at debt ratio. They will look at if a country has an economy has independent monetary policy or not, or if the monetary policy is pegged to another country. They'll look at GDP growth rates, private sector growth rates versus public sector growth rates, and many other economic numbers. It's still quantitative, but that are reflective of fundamentals. So they put these numbers together and sort of create a formula. It's a very systematic approach. It's unique in that most fundamental approaches are not as systematic as what Dalio and Bridgewater utilize. Long-term cycles, that's definitely key to in history. This relates to history. It's very similar to Martin Armstrong in a way, or there's an overlap there. For instance, one long-term cycle, which you can see on the screen now, is the U.S. debt as a percentage of GDP. When that number gets really high and when it's accelerating really sharply, they'll be looking for bubbles and they'll be looking for an onset of a period of deleveraging where there's not going to be that much asset growth and a lot of capital is going to be spent towards paying off debts that have been run up. That's sort of the view that Dalio has, that what 2008 was, a year of the Great Depression, and he comes to that view from U.S. debt as a percentage of GDP, examining cycles there. Diversification is the holy grail. To clarify, diversification, they don't necessarily mean, or they're not really talking about correlation. So there's the argument that everything's correlated now, so diversification is not really possible. Dalio says it is possible, and he's looking at what has independent drivers. So if two assets are driven by completely different fundamental factors, that constitutes diversification. On the screen right now is an example, U.S. stocks versus international stocks. They're going to be driven by different factors related to different monetary policies and what's going on in those respective economies. And that scale also reflects the benefit of diversification that Dalio seeks to achieve. In that, once you get to like 15 different assets, you can really reduce the volatility, the risk, without necessarily reducing the return. This chart also illustrates that concept. You take risky asset 1, for instance, U.S. stocks, risky asset 2, international stocks, or stocks outside the U.S. Portfolio of both allows you to smooth things out. You're not really compromising on return, but the volatility of that portfolio has the potential to be reduced. Need to accept being wrong. That's really important to Dalio's method. Embracing mistakes, learning from them is a big part of the culture that's been that he tries to implement at Bridgewater. Traders go through pain, like he said. Successful traders experience horrendous losses, often before they can get to that point of being very successful. It's a common theme with many traders. That's about it. Any questions, anything you want to share, join us over at informedtrades.com. Thanks and best of luck in your trading.